The best-performing stock market on Earth just entered a bear market. It's down 20% in 3 weeks, and still up more than 70% this year. Both of those are true at the same time. Today, the full story of South Korea's AI mania, the fastest tripling in modern market history, the crash that followed, what the world's analysts are fighting about, and what a century of manias says about markets that look exactly like this. This story has everything. The fastest market tripling in modern history. 2 companies worth more than their entire country. Brand new leverage products launched at the peak. 6 trading halts in 1 year. Record earnings met with crashing prices. And analysts calling the same market a bubble and a bargain in the same week. And hold one question until the end. There is a single upcoming event that everyone agrees will decide which side is right. We'll get there. Start with the record itself. At the peak of the dot-com bubble, the Nasdaq tripled in about 2 years, 1,574 in early 1998 to 5,132 at the top. South Korea's Kospi just tripled in under 18 months, from 2,401 at the start of last year to above 8,000, 6 months faster than the most famous bubble in modern history. Up 75% last year. Up another 70+% this year, hitting a record on June 19th. No major national index has moved like this in our lifetime. What's driving it is real. Every AI accelerator needs high-bandwidth memory, and 2 Korean companies dominate that market. Samsung is up 150% this year. SK Hynix, the HBM leader, is up 200%, and in June, it overtook Samsung as Korea's most valuable company, the first new king in over 25 years. On July 10th, it listed on the Nasdaq, priced at $149, raised $26.5 billion, the largest U.S. listing by a foreign company, and opened 14% higher. The engine is genuine. Hold that thought. Now the scale. Samsung and SK Hynix together are worth about $2.31 trillion, more than South Korea's entire annual GDP. If the country saved every single one it produces, spent nothing, it would take almost a year and a half to accumulate what these 2 stocks are priced at. 2 companies worth more than their whole country's yearly output. Whatever else this is, it is historically extreme. Here's the structure underneath. A year ago, Samsung and SK Hynix were about a quarter of the Kospi's weight. Today, they're roughly half. As one analyst put it, a sharp move in either name drags the whole index with it before the other 900 listed companies get a say. Remember this slide. It explains almost everything that happens next. The same concentration that built the rally built the fragility into it. Now, the human side, and if you've seen our mania episodes, this will feel familiar. A viral post claims a private academy teacher turned $500 million won into $3 billion on Samsung. Real or not, it set retail imaginations on fire. Leveraged retail bets hit records. The financial regulator publicly warned they pose a risk. The finance minister warned of herd mentality. And the detail historians will love. In mid-June, at the very top, Korea launched its first-ever single-stock leveraged ETFs on Samsung and SK Hynix. Every generation invents a new way to borrow into the top. In 1929, it was broker loans. In 2026, it's an ETF. And look at how this market now behaves. 17 buy-side sidecars this year. Emergency halts on the way UP. 6 circuit breakers. Crash halts, which is half of all circuit breakers Korea has triggered since the mechanism was invented in 1998. The volatility index is up 200% this year and touched 86, a genuine panic reading. And in June, an 8.3% crash with a circuit breaker on Monday, followed by a buy-side halt on Tuesday. Fear to greed in 24 hours, as a routine. Then came the 3 weeks that changed the story. June 19th, record high. June 23rd, a plunge of nearly 10% from the record. July 2nd, Samsung and SK Hynix lose $290 billion of value in a single day. July 7th, another circuit breaker, on the very day Samsung reported record quarterly earnings. July 8th, the index closes at 7,246, 20% below the peak. An official bear market. And then, July 10th, a 2.5% rebound violent enough to trigger the 17th upside halt of the year. 13 trading sessions from record to bear market, in an index still up 70% on the year. What actually triggered it? Trigger 1 came from America. Broadcom guided AI chip sales to $16 billion, up more than 200% from a year earlier. The market wanted 17.2. The stock fell 15%, and the Philadelphia Semiconductor Index had its steepest drop since March 2020. Sit with that. Tripling your sales counted as a miss. When expectations are priced like that, the risk isn't the fundamentals, it's the expectations. And no market on earth was more exposed to chip sentiment than Korea. Trigger 2 is subtler, a whisper, not a headline. Meta announced it's moving to mass-produce its own AI chips and disclosed it's exploring selling surplus computing capacity. Morgan Stanley told clients to trim chip makers and rotate into the hyperscalers. Notice what the fear actually is, not that AI fails, that the infrastructure build-out phase peaks, that the furious data center construction becomes less capital-intensive. Memory makers don't live off AI, they live off the build-out. If it slows even slightly, Korea feels it first and hardest. Trigger 3. The world intruded. Iran-Israel missile exchanges and Strait of Hormuz risk hit oil, inflation expectations, and the Korean won. Classic reasons for global money to step back from an emerging market. And step back it did. Foreign investors have net sold about $22 billion of Korean stocks since May. $12 billion of SK Hynix alone in a single month. As one strategist put it, funds are recognizing the risk-reward has shifted in crowded AI positioning. 3 exits, 1 narrow door. And now the strangest fact in the whole story. On July 7th, Samsung reported record quarterly profit, beating forecasts, with memory prices still strengthening. The stock fell 7% the same day, and the market tripped a circuit breaker. Record results, panic selling. One analyst framed it precisely. The market is questioning the pace of earnings growth, not the sustainability of AI demand itself. When even perfection triggers a circuit breaker, price hadn't been tracking fundamentals for a while. It had been tracking a dream about them. Here's where honest people split. The bulls. At the lows, the Kospi traded near 6.3 times forward earnings, a level 1 analyst called approaching global financial crisis cheap. And the earnings are real, records still rising, memory prices strengthening with 2027 orders already placed. The bears answer with the oldest lesson in cyclical stocks. They look cheapest at peak earnings because the E in that PE is a forecast that the boom continues, and memory is history's most brutal boom-bust industry. Both readings are honest. And note the difference from .com. 6 times real earnings is nothing like 100 times dreams. The question isn't whether the earnings are real, it's whether they're peak. And the bulls deserve their full case, because it's strong. J.P. Morgan argues the memory shortage will widen next year, with customers already placing orders for 2027. SK Hynix just committed $64 billion to new fabs. The government announced an $800 trillion national chip ecosystem plan. Fund managers call this a positioning correction, not a fundamental one, and expect foreign money to return because Korea sits at the center of the global AI supply chain. Chip exports were 40% of Korea's exports in June. The order books are full. The operational data has not cracked. The bulls are not dreaming. So run the mania checklist we've used across this channel, honestly. Tripled faster than .com, ticked. This time, it's fundamentally grounded. The exact sentence heard in 1999 and in Tokyo in 1989. Ticked. New leverage products invented near the top. Ticked. 1929's broker loans reborn as single-stock ETFs. Viral fortune stories and ignored regulator warnings. Ticked. But the biggest box of all, absurd valuations on non-existent earnings, does not tick. .com peaked above 100 times earnings on companies with none. Korea trades near 6 times record profits. 4 boxes tick. The biggest doesn't. Manias rhyme. They don't photocopy. But before the bulls celebrate the checklist, one warning that applies to every top ever recorded. In 1999, Nasdaq earnings were strong at the peak. In 1989, Japan's economy was booming at the peak. At the top, the fundamentals always still look fine, because price tops lead fundamental tops, and confirmation only ever arrives afterward. The data hasn't cracked is a true sentence at every single peak in history, right up until it isn't. It is also a true sentence in every healthy bull market. That's precisely why nobody can call it in real time. And here's the one conclusion that survives no matter who wins the bubble debate. Whether AI demand peaks next quarter or runs for a decade, this market structure guarantees violence. Half the index in 2 stocks, brand new single-stock leverage products, record retail margin. That combination produces 5 to 10% daily swings as the new normal in both directions. Fragility doesn't care who's right about the fundamentals. Concentration plus leverage is dangerous in a bubble and in a boom. If you trade or invest anywhere, that's the lesson to take home. Let's recap. Korea's Kospi tripled in under 18 months, faster than the .com Nasdaq, then fell 20% in 3 weeks. 2 companies became half the index and outgrew their country's GDP. Concentration built the rally and the crash. The triggers. Broadcom's 200% wasn't enough moment. Whispers of an AI capex peak, war risk, and $22 billion of foreign selling. The honest debate, 6 times forward earnings, historic bargain, or the oldest peak earnings trap in cyclicals. And either way, concentration plus leverage plus margin guarantees violence. Fragility doesn't need a verdict. And the question I asked you to hold from the start, the one event both camps agree will decide this. It's the upcoming announcements from Microsoft, Google, Meta, and Amazon about next year's AI spending. If the build-out accelerates, the bulls' 2027 order books become real, and 6 times earnings was the bargain of the decade. If it flattens, the E collapses and the trap springs. So, which side are you on? GFC-cheap or peak earnings trap? Tell me in the comments and subscribe, because when the answer arrives, we'll revisit this episode together. If this helped you understand the biggest market story in the world right now, please hit subscribe. This is the market story, the stock market, from basics to advanced, one story at a time. See you in the next one.